Hi, Peter. Welcome to Winter with Grace. We're live.
Hey, Grace. Good to see you.
Awesome. Okay, so let's talk about like this really random experience of like you found an online retail store and ranking community for music festivals. What was that?
Oh man, that was like much younger person. Um, started as like most good business ideas do. We were doing internships during the summer in college, and we were like, we hate these. We do not want to be in Excel all day. This is so boring. And what do we love? So we love going to music festivals. So we were like, okay, we're going to create a business. The original idea was like a pitchfork for music festivals to help people figure out where they should go,
Oh wow.
and like rank them and all this stuff. And then we funded it by doing a lot of merchandise sales at the
Mhm.
festivals themselves. So we like drove around to, I probably attended, I don't know, 70 music festivals over 2 years. And that was a wild experience. Like we're,
Mhm.
selling things during the day at these music festivals, getting people to sign up for the website, driving, sleeping in Walmart parking lots, going to the next one. Like, I don't think I've ever worked harder in my life, but it was awesome. Super fun.
That's crazy.
Yeah,
What?
it was crazy. It was really wild, but it was it's cool to build stuff with your friends. It's
For
been really
sure.
fun.
Okay, so let's talk about like your real life experience. I want to like just do like a quick background check. So, because like before Carta, you were so I like that you started your career in like media analyst or like as a account manager somewhere,
Mhm.
and like I wonder, how does like data plays into this entire marketing realm? And since
Mm.
like you ended the last like job before not the last job like one of your core like major like life experience which is like over 7 years you were at one company and
Yeah.
like you ended as like the head of marketing. I wonder like how does data play into the marketing um game and like how like yeah like what does that mean for marketer to like leverage data to like marketing a company.
I feel like a lot of marketers think about data as just sort of performance marketing. They think about data and they say, okay, how are our ads doing? What's going on with the paid performance of the outreach that we do to
Mhm.
customers? And that's just like one tiny slice of it. So I really think it's absolutely valuable. And in fact, it's becoming more and more, I would imagine, table stakes for marketers to deeply understand data. Not just paid performance, but how
Mhm.
is the business at large doing? How do we acquire customers? At what rates do those customers churn? What are the business metrics generally? And then from my background, I started, as you said, like as a media analyst at this
Mhm.
tiny startup, and then quickly started running data teams and then ran the marketing team for a while. And like having both sides of your brain work that way, so you have the creative sort of brand aspect of marketing and then the data driven aspect from analytics, it's really really valuable. Sometimes marketers get, especially on the content or other parts of the marketing team, they get kind of scared off by data, or they
Mhm.
find it's like not what they came to do. But it gives you such an advantage if you can uh, converse with the other teams in the companies in the same language that they're using. And then the other big thing, and this is like a personal hobby horse of mine, but so just go shout me down if this is boring. But um, I really think that all marketers should learn SQL.
Mm.
SQL has been such a major unlock to my career. What it does is it just removes your need to have someone else do something for you. You can go and pull the data yourself. You can go and investigate how something did yourself. And
Mhm.
that, as a marketer, is a gigantic unlock on your time. So you
Mhm.
can go and build and iterate and test and then find the actual results
Mhm.
and do it again. And it just makes you faster. And anything that improves that cycle time is more than useful.
I wonder okay, so sequel. Okay, learn sequel. If you didn't take away anything, just take away
Totally.
this. So I wonder, okay, so you are the senior director of insights at Carta right now. What
Mhm.
does that mean? Like, because I obviously I read all the reports that you guys wrote, and like I wonder, like, how does the report was compiled in what fashion? Like, I
Yep.
know Carta has a lot of data, like, which is, for the audience who don't I don't really know if my audience would not know what Carta is, like, but maybe it's useful for the audience who, like, randomly stumble upon this, like,
Sure.
to have a general idea on, like, you know, what Carta is, and then, like, how do you guys kind of, like, study the data?
Yeah. Um, Yes. So, quick background on Carta. Carta started as an equity management platform.
Mhm,
We currently serve about 45,000 startups. We run their cap tables. What does that
mhm,
mean? It means that if you log into Carta and you're a startup founder, you can grant equity to employees, you can grant it to advisors, you can track where your employees are on their vesting schedules. Your investors can also get equity when you fundraise from them during their rounds. It's just think of it as the single source of truth for
mhm,
who owns what percentage of a startup.
mhm,
And that can get pretty complex as you get later on. We've got all these investor rights and downstream impacts to
mhm,
equity, all that kind of stuff. So
mhm,
that's the core platform.
mhm,
We've actually added on a lot of things since then. So we were founded in 2013. Um, First and foremost, we also run the back office for 2,500 venture funds across the US. So
mhm,
that is fund valuations, reporting. We help with tax and audit, everything that a fund needs to do in order to do their core job, which is investing into startups.
mhm,
We help them do that. So these two data sets, one from founders and the company equity, and then the other from funds and the investment strategies, give us this like really cool central place in the US startup ecosystem. And then
mhm,
my job as the head of insights here is to make that data more useful to everyone else.
mhm.
So I exist, my role exists so that people who maybe if they're customers, fantastic, but even if they're not customers yet, they can find some value in what Carta knows about the market. This is really, really difficult to find any good data on what's going on in early stage startups, especially if you're a founder and you can't pay a really high price for PitchBook or other
Mhm.
places. You're just kind of taking, advice from your friends, or maybe your VC has a couple examples of what happened to their last couple companies. So what we do is we provide some market reality to say, here's where valuations are, here's how difficult fundraising is, et cetera, so that at least you're talking about the same language.
Mm. Okay, let's actually talk about the findings.
Yeah.
So I want to quickly say hi to the audience. Hi, Ronald. Okay, so so one of the finding is funding decline. Obviously, it's like
Mm,
not super. It's not like necessarily like a news, but okay.
sure.
So according to your report in the Q1 2024 report, so a 29% decrease in new funding rounds compared to the previous quarter. Um, can you unpack a little bit more about like, how, why that is happening, and like, are we looking at like we're at the bottom of the things, or are we looking at we'll like be even more bottom from now? So like how
Totally.
does it look like for you?
I man, I don't really want to call a bottom necessarily, but it is
So
definitely the
it's not a
case.
bottom.
It's I mean, I really hope we are. So taking a step back, uh, what the biggest context to have when you're looking at these fundraising numbers is just how wild 2021 got. It
Mhm,
was an absolute bonanza of venture capital fundraising. So
mhm,
again, we were talking about those like 45,000 startups on Carta. Collectively, those
mhm,
startups raised $220 billion in 2021. That is a massive number. And so, yes, it was about 120 billion in 2022, and it was about 65 billion in 2023. So the decline from that peak has been really, really steep. And then lately, it's just kind of bouncing along the bottom, like 16 or 17 billion dollars a quarter every quarter for the last 4 or 5. And so I wouldn't say like, yes, rounds were down and cash was basically equal. I wouldn't say that funding is getting materially worse at the moment from say 3 months ago, but it's not really getting better. And
mhm,
you kind of expected that, okay, interest rates changed in early 2022. That's
mhm,
a giant factor in why all of this happened. But we're about 2 years beyond that. So shouldn't the ecosystem just kind of have figured it out by now and we get back to funding? Um, there's VCs have raised a lot of money. There's a lot of dry powder available. They're just not investing it at anything like the rates they used to be. So, founders who are trying to fundraise right now are having a really difficult time. There's AI and the slight differences with that industry. It's definitely doing better than most, but even there, it's still not easy.
mm. I wonder, so like when you mentioned AI, so like one news is like maybe yesterday or something, Pika Lab raised like $80 million like in Series B, I believe. Like, so I
Yep.
wonder, when you're looking at these like mega AI rounds that's been racing, like compared to the past, like do you think there's like a slowdown there? Or like do you feel like these companies are not like that company in particular, but like overall the AI companies are like still overvalued? Or do you feel like they're
Hmm.
coming down to like a more reasonable um valuation?
It's really tough to say. I mean, there are, well, sorry, wow, I just heard that twice for some reason. Anyways,
Yep.
are AI companies overvalued? It's really almost impossible for to say. I think that there's this idea that somehow the valuations that are applied to these companies are pretty much right. And they actually never are in the private markets. You
Mhm.
don't really know whether or not a company is going to be the billion-dollar outcome that you think it is, or if it's going to go to zero, which most startups do. So the valuation is much more a mark in the ground of supply and demand for that startup rather than, hey, this is actually the inherent value of the business. If I had to bet, yeah, I bet a lot of AI companies are overvalued. And I also bet there's going to be a few of them that are way undervalued right now. And they're going to be 10, 20, 50, $100 billion companies in 10 years. So it's really difficult to say. I will say that those deals are having more, those are deals that are being closed faster. They're getting a lot more attention. There's a lot of hype around AI right now, and maybe that's difficult to sort of suss out. Hey, is this just hype, or is it going to be a meaningful, actual business down the road? There's always a fun hype cycle in VC. It seems it was blockchain, now it's AI.
Mhm. Um, okay, so is there a research that's been done that like, what are some funds that are like perform really well before the hype cycle become a hype? Because I feel like
Mm.
that's probably like a really important place to look at. Like since like I feel like of course AI is hot now, like everyone's investing in AI, but like is there like let's call it like three people or three funds that are like
Oh,
always before the trend?
I just don't know. There's certainly, I'm sure, funds that are run on Carta and those that aren't run on Carta that are amazing at it. I don't know if I want to call out individual names. There's been, obviously there are people that were like right, super right on some really amazing big names,
Mhm.
you know, the benchmarks and all that kind of stuff, who invested in Uber early on
Mhm.
every so often. But it's kind of difficult to say in AI since it's so early who was there first, or who got it really, really right.
Okay, so also another question is like, you mentioned about the data about like, the decline of like, 2021 was really crazy. It was like
Yep.
$220 billion raise. And like I wonder for that particular era, like because the pandemic was happening, like why was there like a major rush of like capital into the ecosystem, and like what plays into the factor of like people invest massively?
Yeah, it's a good question. I think there was a couple factors that sort of played congruent roles into why that year in particular was such a boom year. So first, 2020, there were real significant worries. If we all remember back into like March, April, May of 2020, there were a lot of startups that actually laid a lot of people off because they
Mhm.
were like, we don't know, this is so uncertain. We don't know what's going to happen.
Mhm.
We may not have a business. And then it turned out that everyone being at home, at least for digital startups, was a huge boom wave. Like Zoom took off, like all of these things. There was just this giant wave of investment from consumers and B2B into digital tech companies because it was
Mhm.
all we could do. Um, so that happened. So people were very, very excited. Companies like Zoom and others were growing incredibly quickly. And so capital typically chases those growth rates. And then it just kind of got to be overwhelming. There was the crypto hype. There was all sorts of it kind of felt
Mhm.
like people were saying, we're in the new normal. Like the
Mhm.
pandemic pulled forward this digital transformation 10 years. And really what it did was there was that spike, but then when we got out of our homes, we kind of
Mhm.
went back to normal or like close
Mhm.
to normal-ish. And so that was this boom and then
Mhm.
this decline for a lot of those early, I think Peloton is a fantastic example.
Mhm.
Um, So there was a ton of capital invested. And then the other major factor was we were just at the end of this really, really long period of super low interest rates. And interest rates, they seem, pedantic or just kind of very far removed from startups. They're not. They're the key reason why someone might choose to allocate more or less into the venture capital asset class is probably interest rates. So as interest rates stay low, capital has to go chase riskier and riskier bets in order to make alpha. If interest rates are high, you take on less risk. So crossover funds, people that invest into real estate, public markets, and private markets, they were all kind of focused on private markets in 2020, 2021, and early 22. And now they've kind of stopped investing so much in venture capital.
Oh, wow. So I guess like when you're thinking about the current state of from like interest rate to, the other factor you mentioned is like capital chase, like the growth rate. So basically there's not a lot of like growth seen in the startup ecosystem right now. So like people are not really chasing anything right now.
Yeah.
I wonder like, number one is like, I guess like, since like, I don't really know if you have any prediction on like these two factor changing anytime soon.
Yep.
I'll save like other question for later, but maybe we just address this question for now.
So what's happening right now in startups is that the grow at all costs model has been replaced by grow at some cost, but have an idea of either profitability or when you're going to actually start making money. And that's a big change. There were a lot of companies that were founded in 2019, 2020 that tried to just grow as fast as possible. Money was cheap. You want to pour on growth, capture a big, big market, and then worry about making money, actual profits later on. Now there's a lot of, when founders go into VC meetings, there's a lot of talk about margins and unit economics and profitability metrics that perhaps weren't there before. And so the burn rates are much lower and companies are being much more cautious with how they're spending money. At the end of the day, though, there's this kind of weird thing that's happening. I don't know if I have a prediction for whether or not, I don't know what interest rates are going to do. There's a lot of smarter people than me who can talk about interest rates. I do know that there are a lot of founders who are kind of caught between these two worlds. So the VCs at first told them grow at all costs, and they did that. And then they said, no, that's not good. You got to grow profitably and get your unit economics in order. And so what do those companies do? They laid people off. They stopped spending so much money. They've made real changes to their business over the last 2 years. And now maybe they need to fundraise again. And guess what? They go to VCs, and those VCs are telling them, you're not growing fast enough. So they feel kind of like I did everything that you asked me to do, right? I did the thing. Why is the capital not there? And it's because underneath that change, the VCs are now expecting a much higher growth rate or better business or different ARR metrics at the same stage. So when it used to be, if you had $1 million in ARR, you could probably raise a Series A. Now maybe you need 2 million or even 3 million to raise a Series A. So I feel for entrepreneurs who've had like all this kind of change happen underneath their businesses, and they're just kind of running as fast as they can to keep up.
I want to quickly say hi to the audience. Hi, Kevin. So I want to talk about the growth rate. So is there any Carta report that's focusing on like, okay, so here's the benchmark on growth rate at X sector, that kind of thing?
Unfortunately, there's not. Our data, because it comes from the cap table, is really fantastic on valuations and fundraising. It has a little bit less to say about financial metrics because we don't really get those at the same cadence. We're trying to work on it, but we don't really have a great idea of that now. So most of my intuitions about growth rates come from conversations with VCs.
Okay, so I want to talk about some of other like great findings. I took notes. Okay. So let me just like pull out my notes. Okay. So number two, like one of the really interesting thing you talk about is like over 40% of seed or Series A financings were bridge rounds. For the audience who may not be super familiar with bridge rounds, why don't we start with like a quick background on like bridge rounds and like why this is happening?
Definitely. So you can think of a bridge round as any financing or fundraising that happens after the primary round, but isn't yet to the next stage. So let's use an example. If you raise a seed round, you might raise $3 million in a seed round. But then, so the next step would be a Series A. But as we just mentioned, maybe the metrics changed or you can't quite get to that Series A. So you might go back to your current investors who did your seed round and say, look, you still believe in this company. I still believe in this company, but I need a little bit more cash to get to a Series A. So we're going to do a seed bridge round. Sometimes it's called a seed extension. Sometimes it's called a seed plus second seed. There's like a thousand names for it. But so that bridge round, if you raise $3 million in your seed round, you're probably not going to raise another 3 million in your bridge. It's probably going to be like $1 million, maybe just a little bit more cash to tide you over, to get you over the hump so that you can go on and raise your Series A. That's the definition of a bridge. Why are these important? Or go ahead. Sorry.
Oh no, I wasn't saying anything. I was just saying like, why is this like, like why is this happening? Like the 40% situation.
So it's the highest, as you mentioned, it's like 43% of all the seed rounds on Carta are actually bridges, not new primary seed rounds. That's important for a couple of reasons. One, I think it's happening because of the shifts that we've already talked about. So they raise their seed round in a totally different world than they live in right now. And they just don't have the capital, even though they made all these changes to the business. They don't have the capital to get to a Series A. So that's why a lot of founders are going to their current investors. Why is it important though? So imagine you're a VC, and in a typical year, maybe call it 20 or 25% of your portfolio companies would come to you and ask for some more cash. What if that was 80%? What if that was 90% of your portfolio companies in the same year are all asking for a little bit more money? Well, you don't have enough money as the VC to support all of them. You're not going to do a bridge with all of those companies. So you have to choose among these portfolio founders, some of whom you just invested in. You have to choose which ones you're going to bridge, which ones you truly believe in. And then the rest of them, you kind of have to say, look, you're on your own. I hope that you find more capital, but we can't support you that way. So it's a tough moment for VCs, tough moment for founders. And it makes all of this bridge activity, there is this kind of idea around venture that many of these bridges are actually going to be quote unquote bridges to nowhere. Like, yes, you gave them a little bit more capital, but they're still not going to make it to Series A. So it's VC is a tough business. Like the most common outcome for VC-backed companies is that they go to zero and they close. VCs don't want you to be a small business. They want you to be a gigantic business so that they can make the money back from their fund. So this bridge round activity I don't think it's a good indicator. Like we would want that bridge round percentage to go lower if the ecosystem was more healthy.
From your perspective, since you study so much data in the space, what would you say would be like 3 suggestions that you gave to like the emerging managers?
The emerging manager side.
We'll talk about that side later because I hear again, like I mentioned, like I was listening to you and like the Turn Novak thing, like from like last year. So you guys were chatting about the emerging manager like boom in the 2021 era. Now it's like kind of gone, not gone, but like people are having hard time to raise money as usual, as like what we just talked about. The entire ecosystem is like very not in the best, like
not healthy. I mean, you can say the same thing. Most of the headlines and everything focuses on founders, but emerging managers are struggling just as much as founders are. So I think there's this word that I don't think I love it, but it definitely sometimes applies, which is tourist, as in, and this, you can apply this to founders, you can apply this to investors, where someone goes, look, yeah, you're a VC, but you only really raised your fund because it was easy. And in 2020 and everyone was doing it. You don't really care about being an investor. Like that's not your highest calling. You're just doing it because it felt fun to do. I think that a lot of those quote unquote tourist investors, they raise their first fund perhaps in 2020 or 2021, and they're just not going to be able to raise fund 2. They're going to try to go back to the LPs, the limited partners that they raised from, and the limited partners are going to go, look, we don't think that you're the right manager for us to invest in. So unfortunately, there was this boom in emerging managers in 2020 and 2021. And I think there's going to be fewer of them raising their second or third funds. And that is a problem for a couple reasons. One, those emerging managers are very often the first institutional check into tiny companies. So they definitely help the earliest part of the market. Two, and this is spoken about, I think, not enough, those emerging managers are often far more diverse than the old managers. So emerging managers are much more likely to be women, to be people of color, to be racial or ethnic minorities that are just getting into the funding side of venture capital. And they're probably disproportionately likely to fund people that are diverse people in as founders. And like, if we want VC to work for everybody, it'd be great to have people on the investing side that are not just the same people that have been investors for a long time. So that's a problem. I don't think it's going to get easier. The emerging manager space is tough because the fund, you raise a fund and then you invest in that for like 3 years, and then you wait for returns for another 6 or 7 years. So it's a 10-year process for a fund. That's so long to wait for feedback. It's really hard to know who's up and who's down before 3 or 4 years in.
So since like the benchmark of like from like the LP perspective, since like I've chatted with some LPs, like I feel like some of the perspectives like it's like if the emerging managers like portfolio company is raised by like the second well like not the second but like I guess like after the full on by like a tier one investor or something, that's like the benchmark
Yep.
for people to look at. I guess like where would so like do you have any information maybe just like from personal observation on like um not I'm not saying like who specifically did a good job or anything, it's just like in general what would be the pattern of these emerging managers are coming from their background or like their approach in investing, who would got picked up by these like call it like a Sequoia or benchmark of the world's the companies.
So where are emerging managers coming from? It kind of, I would call it maybe 2 or 3 main paths. One is, hey, you were a lower level investor at a big fund, so Sequoia, Benchmark, et cetera, and then you kind of went out on your own. And
like big fund spinoff.
Yes, exactly. There's numerous examples of that. One is, and this was an increasingly common thing during the pandemic, was you are an operator or very often a founder at companies, and then you transitioned from being a founder to being an investor, and started your own fund. And then the third is that you kind of were working your way up from the bottom. So you maybe started as an angel investor, and then you did a syndicate, and then as a syndicate manager, you grew into a fund manager. And so those are maybe the 3 main paths for emerging managers. I do, when you spoke to some LPs, I'm not surprised that they said like one of the things that they're looking for is, do you get follow on from major funds? It's definitely a key indicator. There's just, everyone was all of their investments were getting marked up in 2020 and 2021 because the new rounds were coming fast and furious, and it just kind of seemed like everyone was doing well. Now, a lot of those portfolios don't look nearly as good. So, if you're trying to fundraise to your next fund based on the data from your first fund, it's really difficult in a time period where a lot of startups have declining valuations.
When you're looking at the people who were able to raise a second fund, what's the difference between like those people who are like not able to raise the first fund from like your perspective? Obviously, like their track record should matter, but like how like I guess like if there's any common pattern of like things that they've done or like in general, like any advice for like people who are in that position.
It's not a part of our data set, honestly, that I've looked into deeply. So I don't want to come across like I know so much about this space. I do think that the emerging managers who are going to sort of outperform and be able to raise fund 2 and fund 3 here are going to be focused. Like there were a lot of people who did a lot of deals in the boom times, maybe that they were less familiar with. So like if you have a strong thesis, stick to that thesis, prove that it works. And then it just like it is with founders and VCs, like how are you managing your LP relationships? How are you making sure that your LPs are well informed about your business, are like still bought into the thesis? How are you garnering new LPs? How are you like VC is such a network centric business. obviously, like your relationships with your funders are the key thing to say whether or not you're going to have more or less. And then there's some discussion of the funding from those LPs, which LPs are continuing to be invested in and excited about emerging managers, and which ones are kind of defaulting to old strategies and saying, emerging managers were great, but if we only have so many dollars to commit, we're going to commit to some of the managers that we already know. That you got to kind of weigh those two things. So like the quality and excitement within your LP base, I'm sure is a major factor.
Would you say the overhyped deals are always like performed better later on, or like do you feel like it's just like doesn't really have any signal? Like a deal have like a million term sheet, but in the end they failed. But like some deal, like call it like an Airbnb or Uber, maybe like they were overlooked by many major firms at the beginning, but in the end they're like, oh, big success. What does it look like in general in the let's call it like the hype deal segment?
I think it's really difficult to say whether or not a company is going to outperform based on hype. This is actually a debate that's going on across venture capital right now, which is, people say, oh my gosh, these companies, they raise so much money, they're so screwed because the valuations are high. And many of them are, right? No sugarcoating it. The valuations got way out of whack in 2021. And for some companies, it's going to be almost impossible to fundraise again. However, they also have a lot of cash, right? So if you have a lot of cash, you have some time. That cash affords you time to pivot and try new things. So like cash isn't always a bad thing. I don't think if you went back and judged, if you were able to say, give a metric of like how hyped a deal was when it happened versus where the eventual outcome was, I bet there would be almost no correlation. I bet some of the best deals are no hype at all, and some of the worst deals are super overhyped. So it's really just how much conviction does an individual investor have in that business. And that applies much more specifically to the early stage. By the time you get to late stage, you're doing a lot of financial analysis. Early stage, you're just betting on founders.
Let's go back to the sheet. So like let's talk about, okay, I'll start with like a late stage positive, semi-positive line, and then we'll follow with like a little other thing. But anyway, so one of your finding was Series C startups raised 4.6 billion, 130% increase from Q4 2023.
Yep. I don't exactly know why, if I'm being honest. I think that there's
like people crave stability or something, maybe,
or maybe it's just far enough along in that part of the market, B and C in particular, where the companies that are raising a Series C round right now, in order to do so, they probably have to have some very good underlying metrics, because those are the only deals that are getting done. So there are fewer deals happening, but there maybe are more conviction in those deals. Once you're raising a Series C round, you really have to have some very quality financial data to show to investors to say, this is past product market fit. We're now going to scale. We're now going to be a business that you, the investor, should believe could IPO in the next 3 to 4 years, maybe 5 years, depending. So it's a very fundamentally different place in the market than we're a seed stage company. We've shown some promise, but you're still really just making a bet on our future. At Series C, you're making a bet that the numbers show me this thing is going to be really big. So I think it's good to see that, but we got to remember Series C, Series D, like the late stage part of the market, it declined first and fastest. And so now maybe it's just ahead of where the early part of the market is.
Okay, so I feel like I don't want to talk about the negative news, but it is the statistics after all. Okay, so one of the things you like in your report, it mentions that like 23% of the new runs were down runs, and the highest rate over 5 years.
Yeah. This is another like very interesting point within venture capital that I think is misunderstood. So quick definition, down round, any round at which the valuation of the round that's being completed is less than the valuation of the round that happened in the past. So if you have a company, it's worth $1 billion, but then you take another round of funding and it values that company at $600 million, that's a down round. I think down rounds are probably a good sign for the ecosystem as a whole. Seems a little odd, but what's happening there is that founders and investors are coming to a table and saying, look, we got it wrong in 2021 or early 2022. We overvalued this company, but we do think this is a good company. We just don't think it's worth the thing that it says on the door. So we're going to all come together. We're going to each individually take a haircut to our current valuation. It's going to affect the equity of our employees for sure. It's going to suck to message to those employees. It's going to be tough to message to the market, but we believe this is a going business that could be really great. It just is overvalued right now. That to me is a good sign of reality clicking in for both sides of the table. What is also happening that's not shown in as much in the numbers, but I think is bad, is sometimes founders and investors primarily do everything they can to just not take the down round. And when you do that, you might introduce deal terms or structure, like the deals that are actually done at that position can be materially worse for the employees and the founders than just taking a clean down round and moving on. So it's always seemed silly to me that you would imagine the private markets would be better at valuing companies than the public markets. And we know stocks go up and down every day. So to me, I think a down round is just a natural part of this process, but there's no denying that it's no fun. Like nobody wants to take a down round.
So Kevin asked, do you have insights on how many rounds right now are down rounds and a percentage of round rates, say the past year?
Yeah, Kevin, the percentage of down rounds on Carta was hovering around 19 to 20% every quarter for the last year. And then in Q1, it jumped to 23%. To give you a sense of the baseline, historically, it's about 10%, 9 to 10% of deals on Carta are down rounds. So it's twice as many as usual and going a little higher. That's tough. It's not a good market for new primary fundraising that's up or flat. There's just a lot of down round activity happening. Again, I think of this as maybe a silver lining. It means that investors at least still believe in the business somewhat, because the hidden thing is there's a lot of companies that would actually maybe love to take a down round, but can't even raise that. They're just getting no round at all.
I wonder, okay, so I want to switch gear a little bit on a more, I don't know, not light, but like more interesting note in the space is the West region captures like 65% of venture capital raised. I wonder, like, how does this compare to prior to the current state?
I think so that graph that you're referencing is just, we split up all the capital that's invested into Carta companies. We took a look at where those companies were headquartered, and then we just applied that headquarter location to the regions of the US as defined by the US Census. So West, Midwest, Northeast, and South, I think, are the four big ones. The West was, if you look back to 2017, 2018, the West was about 60, 65%. And then as VC got more ingrained in other ecosystems, we've all heard about the rise of places like Austin or Dallas or East Coast like Boston. And New York's been a big VC ecosystem for a long time. The percentage of capital that went to companies located in the West and primarily California was just kind of steadily going down. And I kind of thought that was a good thing. It meant there's more people in more places getting to start companies. In the last 6 months, it's kind of shot back up. So what does that mean? It means two things. One, the AI boom is happening in San Francisco and the Bay Area, and those rounds are bigger. So they kind of drive more capital to that part of the market. And then two, I think, unfortunately, less mature venture ecosystems have pulled back more than places like San Francisco and New York. Like, it's a downturn in SF for sure, but startups are the business of SF. Like, it's always going to be an investing climate in San Francisco, Whereas maybe in Charlotte or Raleigh or, you know, Miami, like we did startups, but now it's kind of harder. So people are not as interested. So I think that's a shame. I wish that it was as easy to start a company anywhere and get funded anywhere in the country. But I think there's still some real strong regional differences.
I wonder, is there any like notes on like the, fundings outside of Silicon Valley, like not outside of the US?
Mm.
So, for example, like globally, because recently I've featured like some investor in the Singapore or like in
Yeah.
the UK, and like I wonder, when it comes to like investing globally, like do you see money keep flying in versus like going out?
We have some data for global equity. You know, we have a subsidiary in Europe as well as
Mhm.
Singapore. So those data sets are growing for us. It's kind of tough for me to say like where is money flowing. I think generally speaking, in venture capital, you can say what happens in the US happens first and then it kind of ripples outward. So I know there's been sort of a decline in funding in Europe and
Mhm.
London in particular. Same thing with Singapore, although those are just kind of more nascent markets. So maybe they'll bounce back a little quicker. Um, there was this thing where US investors were more excited about investing into startups that were based outside the US.
Mhm.
I think some of those investors just kind of stopped doing that and said, we're
Mm.
just going to focus on what we know best for the next year or so.
Mm. Hi, Paul. I want to say hi to the audience. Okay, so another question is, so I wonder, okay, so I want to go through like my little list and then we'll cover like other questions.
Sure.
One thing you mentioned like in the report is like layoffs and like voluntary job departures have declined in January.
Yeah.
So I think that's like a good thing, but like I wonder like what's like the whole like impact in the ecosystem, or like what does that mean in general?
Oh, geez, Grace, we could talk about this for like a whole nother hour. I think it's the most fascinating thing happening in startups right now.
Mhm. Mhm.
So, context: layoffs were really bad in 2023. Everybody
Mhm.
knows that. They
Mhm.
were bad in big tech, but they were really bad in startups too. The thing that was also happening though was people were leaving their jobs by choice less as well. So not just getting laid off, but it used to be there was that great resignation period of 2021 where people it felt like people were job hopping all the time. That also was not happening very much last year.
Mhm.
If you had a job in tech and startups, you basically were like, okay, I might not love it, but I'm going to stick around because it's good. It's better to have one than not have
Mhm.
one. So what's happening? Layoffs are headed down. Voluntary departures are also kind of headed down at the same time. Usually those two things don't go in the same direction, but they are right now. Um, and so what does that mean? There's just not that many jobs available at startups. And this really deeply intersects with a lot of companies that are trying to keep headcount flat or low for right now. Like every time they hire someone in 2021, it was like, sure, hire someone else. And in 2024, it's why do we need this person? Are they going to be a material big change to the business? Like hiring is just much more scrutinized.
Mhm.
So that brings up some interesting questions. Like one, will is it possible that if startups are building with smaller teams across the board, that the most people to ever work at startups in the exact same time was in 2022? There's a potential that startups as an industry will just remain smaller in terms of total people working there for quite a while. I think that that's possible, and I also think for those trying to get into startups,
Mhm.
like I got really lucky coming out of school and I joined a startup immediately. Like I hope
Mhm.
that path is still available to a lot of people. So, we all talk about, hey, it's good for companies to restrict headcount, and that's true on an individual basis. But you still want a lot of people working in startups so that they can go and be founders and get the bug. So I
Mhm.
don't know. I have different opinions on it, I guess.
Um, I wonder, like, do you see this trend keep happening, um, until the end of the year? Like, or like, do you feel like this is a trend that's like, I guess, like because of startups like stop hiring, and then like people are more like you mentioned, like people were like leaving by choice.
Yeah.
Back then, like, why do you think that was the case? By the way, that was a really interesting thing too.
Well, because I mean, the offers were wild. You would hear about engineers who were, had been at a company for 6 months or a year, and they were getting 2x their salary from this other company. It's like it just kind of felt like the optimal career path, if you're trying to make the most money possible, is actually to jump between jobs. So that was part of the reason. It also felt like there were tons of jobs available. One of the hidden things, which is unfortunate, is that in the downturn, when layoffs started to come back, the people who were most likely to get laid off were people who had been there for not very much time. So low tenure employees. So like last in, first out. That's also part of the reason why people are jumping now, because they look around and they say, my friend left her job and went to this new company, and then 3 months in, they laid her off. And they don't want that to happen to them. So it's a shame.
Okay, so one of the audience, Carl, mentioned, beyond financial metrics, what other data points do you see early stage VCs increasingly use to evaluate potential investments?
There are a lot of stuff. I think first and foremost, early stage VC, we're talking like pre-seed, seed, there's data involved, sure, but the primary thing that they invest in is you as the founder and your team. It's really just, do I believe that this person will be relentless enough to make all of the decisions they're going to need to make this $1 billion business? So it kind of is prosaic to say that. I'm sure you've heard that before, but it really is true that at the earliest stages, investors are in funding teams, and then they're funding in markets that they believe in. But like right team, right market is the most important criteria that they're going to look at. Carl, to the other things that they're looking at in terms of data points, it's things like obviously growth rate, not just growth rate in ARR, but the quality of your revenue, how recurring is it, all that kind of stuff. And then second is, are you the right person to convince all of these other people to join you? The right partners, the right employees, the right investors? Like, can you attract the right talent to you as the founder? But I'm sure if you asked 100 VCs, you'd get 100 different answers to that question, unfortunately.
Totally. Okay, so I want to be mindful of time. Do we still have 10 minutes? Because I think
I still have 10 minutes. Yeah, let's do it.
Perfect. Yeah, let's do it. Okay. I wonder, now it's more of like a freestyle as like I feel like
Cool.
we covered all my
I love
list.
some rapid fire ones. Yeah.
Okay. So I wonder, since you have seen so many like data in the back end, and I wonder like if there's any like advice that you could give to like founders. So for example, let's say for like towards like Carl's question, like, investor belief in the team, and like number one is like, where do these founders typically come from? Like, so I chatted with one investor, like, I would imagine like people would source from like the YC, Stanford, MIT, or like Harvard, or like maybe some like other like Stanford or something. So,
Yep.
but like, and then one of the investor told me this trend actually started from high school. So basically, I live in the Fremont area, and then like there's like a high school in here that's like a really there are obviously a lot of founders are actually coming from like this high school, and I wonder if there's any earlier indicators that like, let's say call it like a certain group of people that's going to be like easier to get funding than like most other groups.
I don't think that a ton of high schoolers are raising
VC
right now.
I don't think they're just from high school. I think they're just like they all came from this high school.
Oh, they all like they like grew up together at this high school. Yeah, totally. This may not be a good answer for people in the audience, but unfortunately, VC decision making is definitely influenced by credibility badges. And what kind of badges am I talking about? Did you go to the right college? Did you get into YC? Do you know the right people? Did you work at Apple, Google, et cetera, before in a technical capacity and like have deep industry expertise? That it definitely is true. But the biggest thing that people are investing into right now is repeat founders. So if you are a founder who has had an exit of any kind, you are more likely to get VC capital this time than a first-time founder across the board. Why is that? Because money has gotten more costly and they want to take less risk. And that sucks. I mean, VC should be in the business of taking real risks, right? Because they're trying to build these absolutely outsized outcomes that depend on something going really, really right. But in the downturn, I think it's very clear that VCs would rather fund repeat founders who've done it before.
Mm.
And so that's not the answer anybody wants. And it definitely is not the case that venture is a fair ecosystem. It is not. The same company, the same idea, the same growth metrics might fundraise at very different rates depending on who the founder is. And so that's unfortunate, but it's just kind of the way the game works.
If there is any statistics on like the founders like age, because I feel like that's something that like I've seen like various version of things. So like so the older
Yeah.
founder will list like the older founder like found the most successful company, and then the younger founders will list the younger founder found the most successful company. I wonder if there's any kind of like actual like data back towards like, you know, the age or like where they live or kind of thing.
Yeah. So on the age, we've looked into this a little bit. There are successful founders across every age. The interesting part for me was that people tend to the median age of founding depends a little bit on the industry.
Mm.
So the median age for a technical biotech business, for instance, is higher than it is for a core SaaS or e-commerce. So
Mm.
it's not to say that there's any meaningful difference between the success metrics in those. It's just that sometimes it seems like founders take a little while to build up technical expertise in a specific area, and then they go found. The other clear pattern was that male founders are on average younger than female founders or women founders. That was
Mm.
a little weird to me, but then when you think about it, maybe it's not as counterintuitive as possible. But there weren't like major differences. That was just one statistical pattern that opened up. I think that I don't know. You can found at any age. It's not really dependent on it's much, much more dependent on your network, your expertise, which is in some way a functions of age. But, as you mentioned, some high schoolers are getting venture funding occasionally these days as well.
What about the first or second time founder?
Well, obviously the second time founder is generally older because they would have had to found the company before. But the second
Oh,
time founder thing is really, really clear pattern in the data from the last year and a half. It's just they're
better.
raising at higher rates. They're
Mhm.
raising more often. They're more likely to get investment from any VCs. The kind of other path that's happening though is there are a good number of founders who are just choosing to not raise venture capital at all. Whereas perhaps in the old times they would have, and now they look at their business and they say, I think I can get to profitability. I think I can fund this out of revenues, and I'm going to do that. And that's an amazing way to build a business. You own a lot more of it yourself. Just a question of like, can those businesses that are revenue funded only really get to venture scale at the same timelines? Not a lot of them have. There are some examples like MailChimp and others, but usually you have to have some infusion of outside capital in order to grow fast enough. But maybe this is a new world and companies are going to do some crazy growth things.
A selfish question in the media space. So I've only seen like, you know, recently maybe one company sold like over 550 million to the New York Times, but like I wonder like why is media a not like profitable like or revenue generation like sector or like not
I'm
scalable in
only,
media space?
I guess I would only be parroting things that I learned from Ben Thompson at Stratechery and other people on this. But if your business is ads and you don't own the relationship with your customer, then you're just going to be competed away by the platforms that actually drive your traffic. So all the social and Google and all those kinds of stuff probably own a lot of the ad value out of those businesses. But there are interesting business models in media that are probably less venture funded. But
Mhm.
I mean, I think Ben at Stratechery is a great example. Like you can build a pretty amazing business as a newsletter writer if you have that direct relationship with your readers and they're paying you a subscription fee. So there'll always be some cool, interesting ideas in media. Maybe this is just sort of a transfer point from one type to the other.
Mm. I wonder, so like, where do you think the venture ecosystem is shifting towards to? Like, so since like we just talked about like less money goes into startup and like less money goes into like emerging managers, um, you know, I guess like the other question would be like, to survive, um, if you are like the person who's fundraising right now, like for your first startup or for first fund, what would be your playbook? Would you wait until like the market gets better so you go out there, have an easier time, or would you go hard to like land up your LPs slash investors to go after whatever you're building?
Go hard would be my advice. There are probably people, again, smarter people than me that would say you should time the market or try to wait for it. In my mind, especially if you're an early stage founder, you just don't have the time. You don't really have the luxury of waiting for the market to be good. Or if you do have that luxury, maybe it's because you're revenue funding in the first place, and then you can kind of fundraise on your own timelines. But in general, I would say fundraise earlier than you think you need to if you think you're going to be a VC-backed business, and expect it to take longer than you anticipate. And those two things augur for starting now. you know, the other thing that you can do though is, and this is true in the VC conversations that we've had, is, just make sure that you understand the expectations that you're going to be walking into from VCs, not just in terms of financial metrics, but how much are you going to raise, and like what exactly are you going to do with that money? A lot of founders will say, well, the thing that I'm going to do with that money is hire. VCs don't seem to love that answer as much right now. Is like, try to keep your team small. How are you going to pour growth on something that's already working? So it's not easy. This is not like, I'm not a founder, so perhaps most founders should just kind of ignore my advice. But from the data, it does seem like there's no reason to wait for a better climate. Like, you don't know when that's going to happen. You should start now.
What about for emerging managers who are raising a tiny fund?
That is mostly like, and this is true for founders too, but maybe is the first decision. It's like, how badly do you really want this? Like, are you going to be a VC for the rest of your career? If the answer is yes, and you were willing to do anything you can to scrape and claw for it, awesome, fundraise right now. It's going to be very hard. It is perhaps the most difficult fundraising environment for emerging managers since the great financial crisis, for sure, maybe even before then. So it is a very difficult time to fundraise for a new venture fund. There's a lot of capital committed to venture as an ecosystem that is in dry powder at the moment. Remains to be seen how much of that will actually be spent, but venture fundraising is going to go through a drought because it just takes so long to figure out who was right and who was wrong. It's a really difficult asset class. So you got to really want it. The other thing is there has been a tendency towards more founder investors. So investors who used to be founders just have a better relationship with current founders. They can speak from experience on some specific interesting questions along the pathway. So, sometimes I've spoken at some college courses and they're asked, how can I get into VC straight out of school? And probably the best way to get into VC straight out of school is to join a startup or be a founder first, and then go into the investing side.
Okay, so I have a 1 minute fire round. Before that, 1 minute fire round. Let's go. What's your favorite book?
What's my favorite book? I love Ender's Game, but also they just made a TV show out of Shogun, which is one of my favorite books. But I actually think the other novel in the James Clavell Asian saga called Noble House is even better. So that's a good recommendation for people.
Who made the biggest impact in your career?
Probably the person who brought me into Carta. Her name is Jane Alexander. She was my old CMO. Shout out, Jane. She's just incredible. So it's really awesome to have a mentor who deeply believes in you.
Who would you invite to your dinner party?
Bill Hader. He has to be a living person.
Yeah.
I think Bill Hader would be my
Bill
first.
Hader, the comedian.
Yeah.
Oh my God. I would invite him and Ali Wong. So
Yes.
I was I'm such a big fan of them, and okay, so I wouldn't go that far. But anyway, so
whatever you get out of that dinner, it's going to be funny. So
yeah, for sure.
Yeah.
Oh my God. So where can we find you outside of work?
Outside of work, SF Parks, mostly walking around with my corgi puppy, who's amazing. Skiing, surfing, Napa, I think the Bay Area sometimes gets a bad rap, or SF in particular, but it's an amazing place to be. So outside, probably.
Amazing. Okay, so I want to quickly say hi to the audience before we wrap up. Hi, Joshua. Hi, Kyle. Hi,
Hello, everyone.
Magaba. Sorry. Hi, Kevin. Anyway, okay. Thank you so much, Peter, for coming on the show. It was such a fun conversation. You should come on like soon again next time.
Sounds great, Grace. Yeah, I really enjoyed it.
Awesome. Thank you so much. Let me
Cheers.
quickly
Thanks,
turn
everyone.